Hello, Mike Swanson of WallStreetWindow.com here. If you would like this video so that I know that you're there. Now, right now, as I'm doing this, it's 12 o'clock, Wednesday, August the 30th, and I thought we'd take a look at some of the charts in regards to gold and the stock market and just talk about investing and trading in general. Because we're actually in an interesting time, even though it feels like nothing much has been happening over the past month when it comes to the markets, because volatility has been relatively small in regards to the past. And the same is actually true for gold and mining stocks. Mining stocks have really had the least amount of volatility this year that I've probably ever seen. And that's led to the moves of the past couple of days, which I think are very encouraging to people investing in them. But I put together a little quick presentation that I want to go through with you really quick. And we're going to go from there. So let's look at the first chart, and this is GDX. And as you know, GDX broke through the $24 level 2 days ago, and that has been a critical resistance point over the summer. It was the high of June, and now obviously 25 is something of a resistance level. That's basically a resistance area of February, and it's where the upper 200-day Bollinger Band is. But I really take that movement through 24 to be the start of something that's going to be very fun for us, or assuming you're invested in gold too. Now, my favorite indicator is the GDX divided by GLD ratio, which you see at the bottom of this chart. Again, GDX is the gold stock ETF. GLD tracks the price of gold. This ratio goes up when GDX is outperforming gold. Now, historically, this ratio is a leading indicator. When it trends up, that's bullish for both gold stocks. It's bullish for both gold. And it's exactly what it's doing right now. It started a downtrend last August, following, of course, the tremendous explosion in gold and gold stocks. Gold stocks went up more than 100% and then peaked out around August. And the ratio started to falter and weaken ahead of that peak, and it signaled that some sort of correction was coming. And I was able to warn people about that in August. Now, I wasn't predicting GDX was going to go below 20, but I knew that weakness was coming. And in the end, successful navigating of the markets isn't about predicting where something is going to go at a certain price or something like that, but understanding when the trend is changing. And this ratio indicator showed us the trend was changing last August, just as it's showing us now that the trend has changed this month. It broke the downtrend line connecting the August high, the February high, just a few weeks ago, signaling that the picture was brightening for gold and gold stocks, and that was forecasting rising prices, and then GDX went above 24. Right now, it appears to be digesting that recent move and setting the stage for a move through 25, probably in September. Now, a move through 25 will be huge. And one thing about this chart, these pink lines on there are the 200-day Bollinger Bands, which measure the long-term volatility for GDX. Now, they've come closer together than you can find them in decades, which suggests that a huge sustainable move is in front of us that I think is going to be very rewarding for people owning the right gold stocks. I own GDX in one of my accounts, but that's my retirement account. But in my main account, my large account, I own individual mining stocks because I believe the right individual mining stocks are going to outperform GDX, and a lot of them pay dividends. And I see this as a long-term investment opportunity. Explain why in more detail in a second. But let's pause for a second and look at gold. This is going back to 2011. So this is going to let us step back and see what are the implications for the price of gold right now. What's really going on? We just looked at the last 12 months for GDX, but let's put that in the big picture. Again, GDX, the GDX divided by GLD is a leading indicator. So the fact that that has broken a downtrend suggests that the trend in gold is going to be more positive going forward too. Well, the obvious fact when it comes to gold is 1350. Well, first 1300 has been the resistance point all of this year. It's defined the trading range of gold with 1200 being support. So that's a consolidation range that we've been in for quite some time. This week we broke into the upside. Excellent news, just as GDX breaking 24 was excellent news. But 1350 is the real long-term resistance point. You can see it's the area of the highs of last summer, but also the area of the highs of 2014 and 2013, 3 different times. And you can actually interpret this entire formation from 2013 to today as some sort of reverse head and shoulders pattern. If you're familiar with such chart patterns, that's a very bullish bottoming formation. But the bottom line is a move through 1350, which I think is going to come, is going to clear this long-term bottoming formation. And who knows where it's going after that. It can be at 1500 in 6 months. It could be at 1600. It can make new highs within a few years and just go crazy. There's people predicting gold's going to go to 5,000. Some people are predicting gold's going to 10,000. I don't operate by trying to predict, future exact price gains. I operate, again, as I emphasized a few minutes ago, by recognizing what the overall trend is and when trends change. So the overall trend in gold is very obvious. It made a long-term bottom last year in the first quarter of 2016. At the same time, GDX exploded and went up more than 100% in the first half of last year. Now, when you get a bull market, in the very beginning of a bull market, typically speaking, the gains off of the bottom can be tremendous in a very short period of time. And that's exactly what we saw with gold. It's exactly what we saw with the mining stocks. The first leg of a new bull market that took gold from about 1,050 up to 1,350, 200-point move, really went a little bit higher than 1,350. But regardless of that fact, historically, though, when you see a new bull cycle that starts at such a gigantic leg up, which actually happened in the U.S. stock market in April 2009, the U.S. stock market went up more than 50%. The S&P 500 did in just like 2 months. Now, historically, though, after such a fast gain off of a major bottom, you will see a consolidation phase that may last 6 months to 12 months or even longer. And I assert to you that that is exactly what we've seen play out with GDX. We had a big correction off the high of last year, which represented the end of the first leg of the bull market, and a substantial pullback. Gold stocks are very volatile, so they can pull back quite a lot when they do drop. And then this year we've consolidated. It's August. It's 8 months of consolidation following a pullback that lasted about 4 months. So here we are a year later, completing this pattern that's typical of such a, the second year or the first consolidation bull market. Now, I use stage analysis, which labels a bull market stage 2. Now, if you think about the stock market, it paused towards the end of 2009 and much of 2010, then broke out, and then went up for quite a long time. So, and a similar actually thing happened in 2004. In 2003, the NASDAQ began a big rally around the time of the start of the Iraq War. I think it was in March. But in 2014, it spent like 10 out of 12 of those months going sideways, preparing the stage for a rally that really lasted into 2007 once it was completed. So this second leg of a bull market is something that tends to last longer than the first leg. It doesn't lead to instant gains of 100% and usually in a couple months, but it goes on for quite a long time. And the right stocks in a move like that can go up tremendously. There's just no doubt about that. So I'm bullish on gold. I think this is a great moment to get involved in gold and in mining stocks, and that's why I'm opening up the total gold trading program this week, thanks to this move above 24 on GDX. To get in it, click below this video. But and join, and you also get a trial to my private Power Investor group that'll give you my top 15 gold mining stocks, all of which I own in my account right now. But let me pause for a second and answer a question someone asked me in my previous YouTube video that I put out about GDX, and in which I was saying, it's breaking out. This is fantastic. And I said in that video, nobody should put 100% of their money in gold stocks or gold, despite me being so bullish on them right now. And this person said, well, what's so good about a diversified approach? Everything besides precious metals and miners is in a bubble. The stock market is in a bubble. He is correct. The cyclically adjusted PE for the S&P 500, that's the cap ratio, has only been higher once in its entire history than where it is right now. It's above the levels of 2007 and even 1929. That's not the only indicator. Warren Buffett's market cap to GDP is at a record. The price to sales ratio is at a record. He continues. Maybe if you have over $10 million, it makes sense to diversify, but most people who watch these videos do not. Most people, period, do not certainly have $10 million. Well, I want to answer that question. Why not put all your money in gold and mining stocks? Why be diversified if the opportunity is so great and the stock market, it could go up a little more, but it's overvalued, which makes it very risky. And ultimately, one day we're going to have a substantial decline, a nasty correction, or a vicious bear market. It's just how market cycles work, and we're so late into this one. And I actually think gold and mining stocks are going to benefit from any weakness in the stock market, because it's going to cause the Fed to proclaim they're not going to raise rates. They're going to lower rates if things get bad enough and actually do more quantitative easing, all which will benefit gold. I think that's actually one reason why gold is starting to go up now and the mining stocks are starting to go up right now, because the outlook for higher interest rates has been pared back over the past 2 months. I said that in July that Janet Yellen has given gold investors a green light, and here we are, where people are finally starting to get involved thanks to that reality. So why not put 100% into them? The answer to that is very simple. That, out of my investment career, I've talked to hundreds, if not thousands, of people that can be amateurs just starting out for brokerage account with $5,000, or even hedge fund managers. I actually had, I think he still does, but a hedge fund manager in the Power Investor group that I talked to on the phone. He's managing actually, I take that back. He's not a hedge fund manager. He's a mutual fund manager managing $1 billion. Absolutely a huge, amazing amount of money. But here's the thing. Out of everyone I know, no matter what their experience level, and I speak from my own experience too, there's one single mistake that causes everyone huge problems at some point in time. And I don't care if they're amateurs, so-called, or someone starting out. I shouldn't use the word amateur, or the massive money manager, or someone you see on CNBC, an investment advisor. I don't care who it is. One mistake that leads to all the other mistakes that can be made, and that is being focused only on one market and betting everything you got on that one market. because here's what happens. It can work. It works for a period of time, and you can make a lot of money when you're right. There's no doubt about that, and it happens. There's a lot of people right now that never sold out of the stock market in 2008, and they're up a little bit. They held through all the turmoil of the years, and now they're up a little bit. There's other people that threw all their money into the stock market in the beginning of this year or November last year who got gains. But the funny thing is, gold is actually up more year to date than the S&P 500 is. But those stock market investors are completely ignoring what's going on in gold and gold stocks. And I think they're now positioned in a way that if they're 100% invested in the stock market, they're going to lag the performance in gold and gold stocks. So they would be better served to have a portion of their money in gold and gold stocks. So why not all of it? Okay. Because what happens if you're 100% invested in something and it works and you watch your account grow even month after month and it's fun, it's exciting, there comes a day in which there's a correction of 15%, maybe 20%. The correction, gold stocks go up and down quite a lot. So it's nothing for gold stocks to go down 30% and still be in a bull market. It's, in fact, basically what happened last year towards the end. And if you're fully invested in something, a 15% correction can cause you to sell out completely in panic because you don't want to lose more money. A 30% correction will almost certainly do that to you. And this is why typically you often, historically, the stock market will correct about 15%, and the corrections tend to end around the 15% level. It's different in a bear market, of course, but the reason that happens is because corrections tend to end when people panic sell, and it's that 15% level that, generally speaking, causes panic selling. It causes someone that's 100% invested to watch their account balance drop 15% and then go, I can't take it anymore, I got to sell, and then they're out. So what I'm telling you is that if you are 100% invested in something, it's very easy to get shaken out on any correction. A 15% drop will do it. And if you don't get shaken out and you hold after the 15% correction and things rally back up and then go back down and break that previous 15% low that was set, you tip into a very vicious bear market. And if you then don't sell, you have a very grave chance of wiping yourself out or seeing things drop 30% or 40% and then selling on a bottom. This is the story of almost everyone in the financial markets. This is the number one mistake. They sell out after drops or on bear market bottoms, and then they get shaken out forever. And then, they may be done for a couple of years, then come back in at the next top, or they get into another market and chase that one and actually repeat the same mistake. So being fully invested in one thing, it leads to huge, eventually, volatility in an account, a big drawdown, and big trouble. And the way to escape that is the easiest way is to be diversified in multiple sectors, multiple markets, and so forth. So right now, I've got 20% of my money in gold and silver, and 20% of my money, a little bit more if you count smaller accounts I got, but in gold stocks. And I'm doing other things with the rest of my money. And the thing is, a 20% position in gold stocks is still a big enough position to make a huge amount of money over the next couple of years. And the rest of the stuff I'm doing with my money is stuff I expect to be profitable too. So I split my stuff up. And what this also does, one of the big problems of you're 100% in one thing is it becomes very difficult to be objective about what you're doing. It's very easy to try to convince yourself that this is going to go up forever or that all corrections are temporary and ride things down when the bear market comes. And again, that loss of objectivity comes from the first mistake of being 100% invested to start with. So I'm very bullish on gold. I'm very bullish on gold stocks. I'm trying to encourage people not in them to get into them because I think they're going to go up. And not only do I think they're going to go up, but I think they are actually safe havens from any stock market weakness that will help people weather a storm that I do think is coming, even though no one, will listen to that or really cares. I do think we're headed, for a correction or a bear market. But the inside the total gold trading program, it's a 7-module course, and one of the modules contains my videos on money management, rebalance portfolio, how to be well diversified, how to pick out ETFs to build a diversified portfolio, and to use a strict money management system to rebalance these positions, to manage risk. And the irony is people have a misconception that the way to get rich is to be 100% invested and make a massive bet on something and have it pay off. When in reality, if you can split up into multiple trades that are working for you that aren't trading together, it actually will boost your overall investment returns in the long run and reduce your risks. So there really is no need to make massive, big gambles. And right now, people as a whole, at least in the United States, are making a massive, big gamble when it comes to their investments. Most Americans are 100% in the stock market. Most Americans own no gold, own no silver. If they're in a better position, they got like 30% of their money in bonds, sometimes 50% if they're older and they've reduced their risks. But man, there's actually stories I've been reading where there's people that don't even own bonds because they can't get the interest that they want, and they feel like they've got to throw all their money into the U.S. stock market to get dividends. And that's a very desperate situation, and it's terrible. That's the environment zero interest rates have created for Americans, and it's a terrible situation. Now, they can escape that, and I've been adapting to this environment myself over the past couple months by doing trades that are designed to generate just pure income. In the options market, that's a topic I'm going to actually start talking about next week after Labor Day, when everyone comes back from vacation. That's the irony too about this week is here we got gold and the mining stocks really doing something important, and almost everyone's on vacation and not paying any attention. And that's actually how these kind of markets and consolidation zones come to an end. But let me talk about the broad market for a second to load up my presentation here real quick. And there's the question I just answered. If you've got questions too, leave one below this YouTube video so I'll see it and I might use it for the next video. So this is the S&P 500 inside of it. Everyone's always looking at, at the Dow, the S&P, the NASDAQ. What are they doing today? But to really understand what's going on with the broad market, you got to look inside that. You got to know what's going on with stocks in general. And this is one of my favorite indicators to measure the internals of the stock market. It's the percentage of stocks trading in the S&P 500 above their 200-day moving average. Well, that indicator actually peaked out at the end of February and has been slowly trending down. A funny thing happened yesterday. The Dow was finished the day in the green. The NASDAQ and the market had a big gap. It gapped down on this Korea news and finished in the green, but the internals are very bad. And in fact, this indicator went red that day. But more importantly is what's the indicator been doing? It's been slowly trending down, even though the Dow made a new 52-week high a couple weeks ago, earlier this month, and the NASDAQ had a little bit of a rally to new highs in July. So this, to me, is a sign of a topping process in the stock market that's going to lead to some sort of drop or correction. Whether it's how big that's going to be, this doesn't exactly tell us, but this type of action preceded the drop of 2015. It happened also November, December 2015, ahead of the dump in the first quarter of 2016. It happened in August and September of 2014, going into that correction, which was over 10%. It happened going into the two flash crashes. So, and it happened a little bit last year, but reversed after the Trump election. So, this is a warning sign, okay, to me, about the stock market. Now, let's look at the stock market itself. And this is the Dow, and it's very obvious what's going on. The Dow went up close to 22,200, and now it's got support at 21,600, which is exactly where its 50-day moving average is. 2 days this month, it's bounced off the 50-day moving average. It did that yesterday. That is a level that's been acted as a support for the S&P and the Nasdaq too, although they have gone below that moving average and are trading around it as I speak. A sign one thing that's happened is the Dow is acting stronger than the other averages since for the past 4 weeks. That's why I'm focusing on it at the moment. But the important thing is the 50-day moving average on the Dow is attracting buyers. If we break that, it's going to signal that we're in a corrective phase. That's been warned by the weakness in the internals. What happens after that will probably fall. I actually think it would be pretty much a certain thing that the next support level is somewhere between the green and red line on this chart, the 200-day moving average, the 150-day moving average, somewhere in that zone we would probably dip to. Let's just say, hypothetically, we break that 50-day moving average in the beginning of September. Well, I think we could then count on the Dow going down to, let's say, 21,000 or 20,800 or something very, very shortly afterwards. And then we probably, hold that level or, bounce or something. And then if we go through it again, we're really heading for a dangerous stock market drop. And again, this is why no one should be fully invested in the U.S. stock market at this point in time. If you got fully invested in January, well, that's great. But if you got fully invested in June and you're sitting here and this thing drops, then you're going to be down. But there's no reason to be fully invested anyway when you've got gold, when you've got mining stocks that are doing good, and you can, and there's other things doing that are interesting too. So that's where we are. And again, the thing about the financial markets is you always need to be learning and adapting to market conditions. So if I look at what have I done, some of the things I've done with the U.S. stock market this year is last year in August, I was short going into the Trump election. And then the day after he won, I got out of those positions. It took small profits and I started to go long. And by the end of that week, I was fully invested on the long side of things. And then I started selling that back earlier this year and sold all of it by the time those internals peaked out on that chart and just made changes. But it doesn't matter. We're in a point, though, where the bulk of that rally is just simply over, and there's no great buy point until there is a correction when it comes to U.S. stock market and panic comes into the market. But there's other things someone can do than be fully invested or this and that. There's other ways to trade, other ways to do things, and that's something I focused on myself this year. I got to adapt to the market situation. I want to still make money trading. How can I do that without having to bet on further market gains or an instant crash or something like that? And that's a strategy I'll present to you next week in a PDF report. Okay. But I think it's obvious that you want to be in the best sectors of the market. And, gold stocks was among the top sectors of the stock market all of last year, even though they had a pullback going into the end of the year. The GDX is still up like 50%. And now we're in the same position where it appears it's going to start to outperform. It's been doing it for the past couple of weeks. I think, we're set up. And if you like trading, if you like investing, if you like buying stocks or ETFs, you got to get the Total Gold Trading Program and be a part of this with me. Be into one of the most dynamic and exciting sectors in the market. When gold stocks go up, they go up a lot. They're very volatile, and that can lead to huge gains. So that's what I got to say for today. And get involved with me, just click below this video, and I'll see you on the other side.